Buddy, nice to meet you all. My name's Bill Bergman. I grew up in the Chicago area, went to U of I and Champaign, went to University of Chicago, MBA and other masters in public policy. I'm now the director of research for this group called Truth in Accounting in Chicago, and had a long, interesting career at the Federal Reserve with some, can you please say hi to Mr. Kucinich for me? I appreciate it. It's interesting that those 28 pages included multiple references to bulk currency shipments. And if you could share that with him, I'd appreciate it.
You on Saturday.
Okay. So,
you can talk to him directly if you're here.
Okay, sounds good. Okay. Yep. Well, again, nice to meet you all. Let's start off, before we get into what our group does and why we care about this stuff, and actually why we respect the efforts of the people at the American Monetary Institute. They're working on the integrity of money, and I come at it from a different angle, but I respect the motivation. And let's go back just before we get into the presentation. What is cash? What do you got? Legal tender is an important component. A related question, though, briefly. What is cash in accounting? Where does cash show up on the balance sheet? At the top of the balance sheet, for a good reason. But what's in that stuff? What is cash in accounting? Go ahead. One of the important components of those Federal Reserve banks throughout the country. What do you think they got in the basements? Lots of this stuff. Because the money is constantly flowing into and out of the Federal Reserve banks to supply the bank's need for cash. But cash in accounting, it's when you look at simple questions and look over and throw the rock over and look underneath and you see the worms and stuff, that's what this is. What is cash in accounting? It's a liquid, readily, anything that can be used, for instance, there's two basic parts of the cash in that account. Cash on hand and cash in a bank. They're both cash. Now let's think about that. How did that start? Well, I still recall, there's a fellow named Charles Ezra Sprague who wrote a book with copyright dates of 1908 and 1909, The Philosophy of Accounts. This fellow was one of the leaders in the development of the first CPA law in the state of New York. He was also a banker. I took a close look at this book and the treatment of cash at this time. Why is 1908 and 1909 significant in terms of thinking about cash in a bank? 1907 was the year before. We had the worst banking panic in U.S. history. People were going to the banks and they're saying, I don't want your stuff, I want my stuff. They were taking it out of the banks. They were scared. They said, I want this stuff, I think it's more valuable than you having it. There was a massive proportion for the time. Well, how did Charles Ezra Sprague treat cash in The Philosophy of Accounts in the book with copyright dates a year later? Cash, horses, you got to be scared about those things. We're conservative in accounting. They may get sick. Accounts receivable, we have to discount that for the probability of no repayment. But cash on hand and cash in a bank are the same thing by definition. Right after the worst banking panic in U.S. history. And then we had the 1913 Federal Reserve Act created to try to solve this problem. The fact that people didn't think these two things were equal things. Even though accounting principles were saying you can put this stuff and this stuff in the same account at the same value. What happened 20 years after 1913? The worst banking panic in U.S. history, at least until 2007. And probably, in important part, because we had the Federal Reserve, not despite the fact that the Federal Reserve existed. So there's some interesting, at the roots of our fundamental accounting principles, that thing at the top of the balance sheet, the most basic thing that's up there, is itself a suspect entity. From there, I'm going to now get into what, our mission, at least, at Truth in Accounting. Truth in Accounting was started in 2002 by a CPA named Sheila Weinberg, a very hardworking, diligent, and smart lady who was looking at the debate over the federal debt and the fiscal position of the U.S. government, and she was hearing people talk about how the federal government was running surpluses, which she thought, in her mind, well, how can you run a surplus and raise your debt at the same time? Something is wrong here with the federal government's accounting. And from there, she started working on that question, and people that were friends of hers in this area in Chicago said, hey, if you care about the federal government on this stuff, maybe you should start looking at Illinois and Chicago. She was very, and one thing led to another, and among other things, our flagship product, at least, the Truth in Accounting, although we have other initiatives, we'll learn about those shortly, is our State of the States report. Our State of the States report puts together all the, we have a measure called taxpayer burden that comes to a bottom line metric of state government financial strength, driven by the fact that historically the state governments did not include retirement benefits and the obligations on retirement benefits on their balance sheet, which are some of the biggest debts that the states had. And she wait a minute, and we're going to see some slides here lately too about Chicago and why her concern with the quality and the integrity and truthfulness of government financial reporting is what drove the beginning of our organization. So let's get into that a little bit. What I'm going to talk about briefly is our mission, why Truth in Accounting started. Can you get the presentation format up? Why we started it, we already talked about that. The Financial State of the States report, the State Data Lab website that basically I built, and thank you. Okay, great. Go down one. Great, that's good. Thank you. What we're doing in the federal government's accounting and financial reporting. In light of the mission of this organization, here's another fun question I'm going to skip to. On the federal government's financial report, the balance sheet of the federal government, it lists about $3 trillion in assets, along with what we believe are an understated amount of liabilities, about $18 trillion in liabilities. And 3 trillion minus 18 trillion gives you the net position of our federal government. It's a big negative number. Go ahead.
On the asset side of the balance sheet, are things like national parks and military airports and everything included?
The one thing that they don't include are the stewardship, land, and heritage assets, including the national parks.
And what about military properties?
Military properties are on the balance sheet. How well accounted for are they is another question.
Are they at market value, or are they at cost, or are they depreciated value?
There's a few different ways they do it, but for the moment, let's just step back for a second. Before I get into that balance sheet for the federal government, I'm going to briefly digress and address what's underneath your question. The accounting statements, the opinions from the auditors, there are various different types: a clean opinion, a modified opinion, an adverse opinion, and maybe the worst of all is the disclaimer of opinion, when the accountant and the auditor says, I'm sorry, your systems are so poor that we can't even render an opinion on whether or not your statements are meeting GAAP. My question for you is, the modern financial report of the U.S. government began being issued in 1998. What type of opinion has the auditor for that report given the financial statements of the United States of America's government, the federal government? They've had a disclaimer of opinion every year, mainly because of the Defense Department and the quality accounting in the Defense Department. And it's not a good statement about the integrity of our financial reporting in the United States, and people just take it for granted. But it's an interesting issue. Well, we got the $3 trillion in assets and we also have $18 trillion in liabilities. When you add Social Security and Medicare to that liability side, which we believe is appropriate, you get closer to, well, in our view, about $87 trillion. But that's, again, there's a debate about how to do this, and that's our view. There's a sentence, or actually two sentences, introducing the balance sheet of the United States government's balance sheet in the financial report of the U.S. government. And they say, in light of your question about the national parks, they say, there are, however, other resources available to the government beyond the assets presented in this balance sheet. It says they include the government's, capital G, possessive, the government's sovereign powers to tax and set monetary policy. In other words, in introducing the balance sheet, the federal government tells us, the people, that it possesses the sovereign powers to tax. And so we should be comforted that they can tax us and inflate the value of our money away in order to restore the integrity of the finances of the federal government. Who is sovereign in the United States of America? That's what I think. We the people. And the reporting entity of the government is saying that it has the sovereign power to tax. An interesting question or two underlie that one. Our basic mission is to educate and empower citizens with understandable, reliable, and transparent government financial information. We care because accounting and financial reporting are key elements in securing government accountability. Accounting matters. It's boring, but it's not when you look under the surface. An important question underneath this all, I wrote something a couple of days ago, and some of the comments were along the lines of the fact that the accountants are lying. That was what, after people reacted to this thing, I wrote, oh, the accountants are part of the problem. And there was an accountant who reacted to those comments and said, no, it's not our fault, it's the rules. We have to follow these rules, and we have to follow it. The problem arises, one of the most important ones, what do you do when the rules themselves are a source of the deceit? And that's the ethical issue underneath this stuff. Here's another quick aside on who makes the rules. Who are the main accounting setters, standard setters in the United States? For the private sector, you've got FASB, F-A-S-B, the Financial Accounting Standards Board. How about for the state and local governments? You've got a different accounting standard setter, the Governmental Accounting Standards Board. There's a third accounting standard setter, the Federal Accounting Standards Advisory Board, FASAB, for the federal government. So 3 sets of accounting standards that are coming from 3 different places. My trick question for you is, who sets the accounting standards for the Federal Reserve? The Federal Reserve, Jamie, thank you very much. The Federal Reserve writes its own accounting standards. And it changes them whenever it decides that it... Go ahead, sorry. The BIS, well, maybe behind the... there's international cooperation, I think, on thinking about things like this. But the Federal Reserve writes its own accounting standards and changes them when they want to. So our flagship product is this Financial State of the States. We've got about 7 years of consistently presented. One thing that's happened in recent years, the GASB has finally implemented accounting standards calling for the state and local governments to put those pension obligations on the books. And this huge new liability that previously wasn't reported is now being reported. And so we're having people, ordinary citizens are going to have trouble understanding this. And in addition, even smart people are going to be are currently being faced with challenges. I'm sorry, go ahead.
I have a question on the bottom of your bottom line. Over $1 trillion in debt.
We'll get there. Okay. Currently, looking at the time trend in accounting results and financial results for governments, it's become difficult because they fundamentally changed the accounting standards. But we have these 7 years or so of consistently presented results for the governments that can help understand what the truth is underneath all the uncertainty with the accounting standards. In our bottom line measure, this measure called taxpayer burden, we take all the assets available to pay bills, subtract all the bills, take out both capital assets and debt related to capital assets, and on a per taxpayer basis, measure how much debt a local or state government has on a per taxpayer basis. And one question that arises when we add up the total for the 50 states, there's over $1 trillion in debt, despite the fact that 49 out of the 50 states have some form of balanced budget requirement. The question arises, if they're balancing their budget, how can they accumulate over $1 trillion in debt, unfunded debt? And the answer is the accounting, and the fake accounting, both in the budgets and in the financial reporting. We're going to see some shocking pictures shortly about the city of Chicago along these lines. So there's our taxpayer burden. Where do you think Illinois ranks on the states on that measure of financial strength? Very, very, very close to the bottom. Once you get to this level, but New Jersey, Connecticut, Illinois, Kentucky, and Massachusetts, those are our 5, quote, sinkhole states. Illinois is certainly one of them.
Who is last?
New Jersey is the biggest sinkhole.
Everybody, can you please not interrupt the speaker while he's talking? Just let him do his presentation and ask questions later. Thank you.
Well, we like talking to you too. So on the federal side, we're also working, and among other things, we've done work on thinking about what happened to Greece and whether or not the United States of America isn't all that different, perhaps, in some ways than what happened to Greece. Social Security, why is it off the balance sheet? Should it be on the balance sheet? And what do you think the federal government's view of keeping it off? Why do you think the federal government thinks it shouldn't report Social Security benefit obligations on the balance sheet as a liability? Because they say the law, we go ahead.
It's because we could always not pay if we wanted to.
That's what it is. They say we create the law, we can change the law whenever we desire, and therefore we're not going to report it as a liability. Does that make sense to you? Student loans, a very fascinating issue. The student loans is the answer to the question, what is the fastest growing asset on the books of the federal government in the last 10 years? Student loans. Whoosh. Especially, now why did the rapid growth rate start when it started? And that was in 2007. Why do you think student loans started accelerating in growth in 2007? I'm not going to do it. I think so. There were a lot of young people who were looking for work and couldn't find it. I wonder what a longer story underneath that idea. The question arises, what do you think the government reports in its accounting for student loans for the expected profitability of these loans for the government?
100% paid.
Well, more or less, yeah. They don't really account for the risk. And on the books, the expected profitability or long-run income from student loans to the government goes like this. A huge increase in recent years. And Elizabeth Warren and others are screaming about the fact that how can our government make so much money off the backs of students like this? And one of the reasons, I'm afraid, is that the government overestimates the profitability of these programs. And whether or not they're going to really turn a profit is an important question. It's very rare that government lends money and makes money on the system. So State Data Lab, we can look at that, time permitting, but we'll see. We have data for all 50 states in State Data Lab, which has over 200 variables of interest for understanding not just state financial information, but the economic and demographic information or context for state and local government finances. I'll give you a brief example of a few of those types of variables. I constructed a gerrymandering index ranking the 50 states from top to bottom in how gerrymandered their legislative districts are. What do you think the relationship is? Are states that are heavily gerrymandered, do you think they're in better financial condition or a worse financial condition? Worse, and Illinois is a great example of that. Another index, well, a few other things that we have in there. I created a zombie index named after Ed Kane, a great professor of finance at Boston College. He was the fellow who coined the term zombie bank back in the S&L crisis. It was this Ed Kane person. And the reason why he did it, the S&Ls, when they were effectively belly up, but the regulators let them stay afloat with false accounting for the condition of their banks. And when that happened, those folks that were effectively, quote, dead but alive, that's why he called it a zombie bank, they had an incentive to gamble, to maximize the value of the equity in these S&Ls. And it ended up trebling the cost of the S&L crisis. I'm afraid we have a similar situation in many state governments today. And the pension plans, which know that they're facing a huge problem, and they may have an incentive to be taking a lot more risk in their investment portfolios to get back to even or stay around. And and Illinois is high on that zombie index as well. Another measure, the last 2 years ago, Gallup polled citizens across the 50 states and came up with a measure and a ranking of all 50 states in terms of their trust in state government. Where do you think Illinois is on that one? At the very bottom, number 50. So just some examples, and we can look at the database maybe later. But that's our state data lab. www.statedatalab.org is the website. Let's take a look now again at an example of some of the problems in the financial reporting and communication that we receive as citizens. Rahm Emanuel arrived as the mayor of the city of Chicago in 2010, and before his most recent re-election was citing the fact that he delivered a balanced budget for the city of Chicago every year. Let's take a look. What is a budget compared to an income statement? What's the fundamental difference between a budget and a...
Well, a budget is cash-based generally.
That's one of the...
Financial reports are
on an accrual basis. So there's one important reason why what we're going to see happened. Go ahead.
A budget is forward-looking.
Forward-looking, and the accounting statements are for a period of time in the past. So a budget is almost like a plan or a perspective picture. Is it always accurately foretell the future? No. And let's see what happened as opposed to what they said was going to happen. How balanced was Chicago's budget in practice? Let's first look at Indianapolis. What this measure is, it takes all the revenue, taxes, fees, and grants, and subtracts the net expenses that are incurred by governments. And it's kind of like a bottom line measure like net income. And this goes up to 2013, and only 2013 for a reason, because we're going to look at Detroit, which filed for bankruptcy in 2013. So here's the, it didn't really balance in 2009. There was a big hit. It's not necessarily all that evil. What happened in 2009, the worst recession since the Great Depression, with an impact on the income statements for state and local governments as well as businesses. But we've seen a recovery of sorts in Indianapolis. Let's put Detroit on top of Indianapolis. What does that look like? Detroit filed for bankruptcy in 2013. Hundreds of millions of dollars more being spent than coming in the 4 or 5 years before the onset of bankruptcy for Detroit. How about the city of Chicago? It couldn't possibly look worse than Detroit, could it? One thing that makes Chicago different from Detroit legally, there's something called home rule, where the city of Chicago is in charge of its destiny financially, relative to Detroit, was more dependent on state government decisions. So that's a source of strength. And the other source of strength is the fact that Chicago claims that it has a balanced budget requirement. Under state law, the state law requires it to balance its budget. So that number, for this number here for Chicago, that should be at 0 or above, shouldn't it? In the 4 years before 2013, after Rahm Emanuel's first election, the city of Chicago spent $1 billion more a year than it took in. What happened to the growth rate in the debt for the city of Chicago? It accelerated. It was twice as high as it was under Daley in that period, despite the fact that there was a recovery in the economy. Now let's update this picture for the last 2 years. One thing that it's going to be hard to see in this picture is the fact that there's a recovery in Detroit. How about Chicago? Is there a recovery in Chicago? As bad as it was, in 1 year, it was like a negative 5.5 in terms of the bottom line. Mainly because of the onset of these new pension standards and the loss of that Supreme Court. A couple of years ago, the Illinois Supreme Court ruled that these pension benefits are constitutionally protected in Illinois, and pension reform allegedly fixed that for Chicago, but Chicago lost in the Supreme Court. They lost the case, and they had to recognize a lot of expenses on that. And so there's Chicago balancing its budget. I guess just to conclude, thank you for the invitation to talk. This conference was where I met Ralph Seify, and I appreciate that opportunity. Ralph was a great guy, a unique character who was a lot of fun to work with when I had a chance to work with him. He passed away of a heart attack suddenly a couple of years ago. So thank you very much.